What caused the Great Recession? Interconnected banks explained. Imagine a world where a single event can send shockwaves through the entire economy. This is exactly what happened during the Great Recession. At the heart of this crisis were interconnected banks and financial institutions. The collapse of the United States housing market was the initial trigger that set off a chain reaction across the global financial system. Many banks and financial firms had invested heavily in mortgage-backed securities and collateralized debt obligations. These financial products were created by bundling home loans, including risky subprime mortgages. Despite their underlying risks, these securities were often rated highly. This was due to financial engineering and derivatives that spread and amplified risk throughout the system. Institutions also issued credit default swaps, which acted as insurance on these securities, further tying their financial health to the housing market's performance. As banks became highly leveraged, they borrowed large amounts to finance their investments. While this strategy increased profits during good times, it also made them vulnerable to losses when mortgage defaults began to rise. Many banks held onto risky mortgage assets, seeking profits from multiple stages of mortgage securitization. This was a shift from earlier practices where firms specialized in one stage of the process. The shadow banking system also played a significant role. These financial entities performed bank-like functions but operated without the same regulations. As major investment banks like Lehman Brothers failed or were sold at fire sale prices, panic spread through global markets. The lack of regulation for these shadow banks meant that risks were underestimated and poorly managed. When key financial firms failed or came close to failing, confidence in the system plummeted. Investors began to withdraw funds, leading to liquidity shortages. This panic rendered financial markets dysfunctional as institutions struggled to obtain financing. Businesses and consumers responded by cutting back on spending and investment. Regulatory gaps and insufficient oversight allowed excessive risk-taking and borrowing to go unchecked. The crisis quickly spread internationally because many foreign banks were involved in United States mortgage markets, and United States banks operated globally. The interconnectedness of banks meant that the failure or distress of one institution quickly affected others, creating a domino effect that amplified the crisis. This situation highlighted the need for better regulation of all financial institutions performing banking functions and for mechanisms to manage risks that can cascade through the financial system. Understanding these causes from a financial history perspective shows how innovations in financial products and deregulation, combined with risky behavior and complex linkages among banks, set the stage for one of the most severe economic disruptions since the Great Depression. It illustrates how vulnerabilities in one sector, like housing, can spread through interconnected banks to affect the entire global economy.